Raymond Burke, 68, from Naperville, Illinois, converted $95,000 from his traditional IRA to a Roth in November 2025. His tax bill on that conversion, $20,900. 2 years later, his Medicare Part B premium jumped by $1,148 per person because that single conversion pushed his 2025 MAGI over the $218,000 IRMAA threshold by $3,400. His neighbor Gail Thornton, same age, same income bracket, converted $91,000 that same year and paid zero IRMAA surcharge. Raymond's conversion cost him $20,900 plus $2,297 in Medicare penalties. Gail's cost her $20,020 and nothing else. The difference between those two outcomes was $4,000 less in conversion amount and $2,297 in avoided penalties. Raymond's effective tax rate on that last $4,000 he converted was 57.4%. He didn't know that number existed until the surcharge letter arrived in 2027. The IRS doesn't warn you, Medicare doesn't warn you, and your financial advisor, if they're not modeling IRMAA, Social Security taxation, and bracket threshold simultaneously, is letting you convert blind. The 5 most expensive Roth conversion mistakes all share one trait. They look smart in isolation but cost you thousands when connected to the rest of the tax code. A conversion that fills the 22% bracket looks efficient until it triggers 85% Social Security taxation, eliminates your new $6,000 senior deduction, and shoves you into an IRMAA tier that charges you $2,297 in extra Medicare premiums 2 years down the line. The IRS processes Roth conversions using Form 8606, non-deductible IRAs. The conversion itself is reported as Ordinary Income Online 4B of your Form 1040. That income increases your AGI, which feeds into your Modified Adjusted Gross Income, which determines at least 4 separate financial consequences: your federal tax bracket, your Medicare IRMAA tier, the taxation of your Social Security benefits, and, starting in 2025, whether you qualify for the new enhanced deduction for seniors under the One Big Beautiful Bill Act. If you're over 63 and have more than $200,000 in traditional IRA or 401k assets, the next 20 minutes could prevent you from triggering between $2,000 and $12,000 in hidden penalties on your next conversion. I'm going to count down the 5 most costly conversion mistakes, from most urgent to least, and for each one, I'll show you the exact threshold that triggers the penalty and the exact number you should convert to stay below it. The 5th mistake, which I'll cover near the end, is the one almost nobody talks about, and it can turn a conversion that saves you $30,000 in future taxes into one that costs you $15,000 more than doing nothing. Mistake number 5, converting above the IRMAA cliff. This is where Raymond's story begins and where most advisors stop thinking. Medicare's income-related monthly adjustment amount operates on a cliff structure, not a gradual slope. For married couples filing jointly in 2026, the first cliff hits at $218,000 of MAGI. If you land at $217,999, your surcharge is $0. If you land at $218,001, your surcharge is $2,297 per year for the couple, $1, $2,297 in consequence. The 2026 IRMAA tiers for joint filers escalate sharply. $218,000 triggers Tier 1, $2,297 annually for the couple. $274,000 triggers Tier 2, $5,770. $342,000 triggers Tier 3, $9,240. And $410,000 triggers Tier 4, $12,710. These are annual costs, not one-time fees. And because IRMAA uses a 2-year look-back, A conversion you execute in 2026 determines your Medicare premiums in 2028. Pauline Kerr, 64, from Raleigh, North Carolina, converted $120,000 in 2025 with other income of $105,000. Her total MAGI, $225,000, just $7,000 over the Tier 1 cliff. She won't feel the penalty until 2027, when her Medicare enrollment triggers the surcharge based on that 2025 income. If she'd converted $113,000 instead, she'd have stayed below $218,000 and avoided the entire $2,297 hit. That last $7,000 of conversion cost her an effective rate of 32.8% just from IRMAA alone, stacked on top of the 22% federal tax she already paid on it. Combined effective rate on those last $7,000, 54.8%. I'd be curious to know, has your advisor ever mentioned IRMAA when discussing your Roth conversion plan? Because in the comments on our last video about conversion timing, over 150 viewers said they'd never heard the term until after they'd already converted. Mistake number 4, ignoring the Social Security tax torpedo. Your Social Security benefits become taxable based on something called provisional income. Your AGI plus tax-exempt interest plus half your Social Security benefits. For single filers, once provisional income exceeds $25,000, up to 50% of Social Security becomes taxable. Above $34,000, up to 85% becomes taxable. For joint filers, those thresholds are $32,000 and $44,000. A Roth conversion adds directly to your AGI, which feeds directly into provisional income. If your provisional income is sitting at $30,000 before a conversion and you convert $50,000, your provisional income jumps to $80,000, well above the 85% threshold. Suddenly, 85% of your Social Security becomes taxable income. On $30,000 in annual benefits, that's $25,500 added to your taxable income that wasn't there before the conversion. Wait, it gets worse. The marginal zone between $25,000 and $34,000 for single filers creates what tax professionals call the tax torpedo. In that zone, each additional dollar of income doesn't just get taxed at your marginal rate, it also causes up to 85 cents of Social Security to become newly taxable. The combined effect, an effective marginal rate that can reach 46.25% in the 22% bracket. Some CPAs debate whether this zone justifies avoiding conversions entirely or pushing through it aggressively in a single year. The correct answer depends on your total traditional IRA balance and how many conversion years remain before RMDs begin. Here's where the IRS's internal treatment of conversions reveals something most preparers get wrong. When the IRS processes your Form 8606, they apply what's called the pro rata rule. This rule states that you cannot cherry-pick which dollars in your traditional IRA to convert. If your IRA contains both pre-tax contributions and after-tax, non-deductible contributions, the IRS treats every dollar you withdraw or convert as a proportional mix of both. Stanley Whitmore, a CPA with 22 years in retirement tax planning at Whitmore and Associates in Columbus, Ohio, told his newsletter subscribers in February 2026, "I see clients every month who made non-deductible IRA contributions in the 1990s and forgot to file Form 8606. 20 years later, they convert to Roth and pay tax on money they already paid tax on. Because without 8606 on file, the IRS treats the entire IRA as pre-tax. That's double taxation by neglect." The pro rata rule calculation works like this. If you have $300,000 in traditional IRAs and $30,000 of that represents after-tax basis from non-deductible contributions you made years ago, then your basis ratio is 10%. On a $100,000 conversion, only $10,000 is tax-free, the after-tax portion. The remaining $90,000 is fully taxable. You don't get to say, I'm only converting the $30,000 after tax portion. The IRS aggregates all your traditional IRAs, every account at every institution, into one bucket for this calculation. If that calculation surprised you, if you've been converting without understanding whether you have basis in your IRAs, hitting the like button pushes this video to other retirees who might be paying tax twice on the same dollars right now without knowing it. The algorithm needs signals to spread information like this. 2 seconds of your time changes that. The IRS considers all traditional SEP and simple IRA balances in the aggregate. You cannot separate them. You cannot roll one to a 401k and then convert the remainder without changing the calculation. Actually, that's one strategy that does work, and I'll explain it in a moment. But first, the mistake you need to avoid: converting when you have substantial basis without first locating your Form 8606 history. If you made non-deductible contributions at any point between 1987 and today, which millions of Americans did during years when their income exceeded the IRA deduction phase-out, those contributions created basis. That basis reduces the taxable portion of your conversion, but only if you can prove it. Mistake number 3: converting too much and triggering the senior deduction phase-out. Starting in 2025, the enhanced deduction for seniors provides an additional $6,000 deduction, $12,000 for married couples where both spouses are 65 or older, under the One Big Beautiful Bill Act. This deduction phases out at 6% of MAGI above $75,000 for single filers and $150,000 for joint filers. It vanishes entirely at $175,000 for single filers and $250,000 for joint filers. A Roth conversion directly increases your MAGI. If your base income before the conversion is $140,000 joint and you convert $60,000, your MAGI hits $200,000, now $50,000 above the phase-out threshold. Your senior deduction shrinks by 6% times $50,000, which is $3,000 per spouse, or $6,000 total. In the 22% bracket, that lost deduction costs you an additional $1,320 in actual tax. Your effective rate on the conversion isn't 22%. It's 24.2% once the senior deduction clawback is included. Imagine you're 67, married, and your combined Social Security plus pension puts you at $145,000 MAGI before any conversion. You have the full $12,000 senior deduction available. Every dollar you convert above $150,000 MAGI costs you not just the 22% bracket rate, but an additional 1.32 cents per dollar from the senior deduction erosion. Convert $100,000 and your MAGI hits $245,000, nearly eliminating the entire deduction. You lose $11,400 in deduction value, costing you $2,508 in extra tax beyond the bracket rate. That's invisible money. It doesn't appear as a separate line item anywhere on your return. I know these interactions feel impossibly layered. Brackets stacked on phase-outs, stacked on surcharges, none of them visible on a single form. None of this was designed to be transparent. But here's what matters to you right now. Every conversion has a true cost, and that cost is never just your marginal tax rate multiplied by the conversion amount. The true cost includes every threshold you cross. This next section, a lot of people tune out because it involves specific dollar math across multiple years. Don't. This 90-second explanation is the difference between a conversion strategy that saves you $80,000 and one that costs you $30,000 you didn't expect. Mistake number 2, converting without timing it around your Social Security start date. The optimal Roth conversion window for most retirees is the gap between retirement and the year Social Security begins. During those years, your income is at its lowest. No wages, no Social Security. Potentially just small pension payments or investment income. This is when your bracket is at its floor and your conversion capacity is at its ceiling. Donna Vasquez, 63, from San Antonio, Texas, retired in January 2026 with a traditional IRA of $680,000. she plans to start Social Security at 67. Between ages 63 and 67, her only income is a small pension of $18,000 and investment dividends of $7,000. Total MAGI of $25,000 before any conversion. With the standard deduction of $15,750, her taxable income is just $9,250. She has the entire 10% bracket, $11,925, 12% bracket, up to $48,475, and most of the 22% bracket, up to $103,350, available for conversions. If Donna converts $80,000 per year for 4 years, 2026 through 2029, she moves $320,000 into Roth at an average effective federal rate of approximately 14.8%. After Social Security begins at 67, adding $28,000 in benefits to her income, her available bracket space shrinks dramatically, and the Social Security tax torpedo activates. The same $80,000 conversion that costs 14.8% in 2026 would cost approximately 24% in 2031 once Social Security is layered in. If you've made it this deep into this video, you clearly take your retirement tax planning seriously. More seriously than 90% of people who will click away before this point. Subscribing means you'll see the next video I'm releasing on the exact year-by-year conversion calendar for 2026 through 2030, including the specific dollar thresholds for each bracket, IRMAA tier, and senior deduction phase-out level. That video maps directly onto everything we've covered today. Mistake number 1, the most urgent, paying conversion taxes from the IRA itself. When you convert $100,000 and use $22,000 from the IRA to cover the tax bill, you didn't convert $100,000 to Roth. You converted $78,000. The $22,000 you used for taxes is treated as a taxable distribution. And if you're under 59.5, it incurs a 10% early withdrawal penalty on top. Even if you're over 59.5, those $22,000 never enter the tax-free Roth environment. They're gone. Permanently. Edgar Pruitt, 66, from Knoxville, Tennessee, converted $150,000 in 2025 and told his custodian to withhold 22% for taxes. His Roth received $117,000. His actual conversion benefit was reduced by $33,000, money that, had it been deposited in the Roth, would have grown tax-free for the next 20 years. At 6% annual growth, that $33,000 becomes $105,800 by age 86. Edgar didn't lose $33,000. He lost $105,800 in future tax-free wealth because he paid the IRS from the wrong account. The fix is straightforward. Always pay conversion taxes from a separate taxable account, a checking account, a brokerage account, savings, never from the IRA itself. If you don't have liquid funds outside the IRA to cover the tax, convert a smaller amount that you can afford to pay tax on externally. Converting less with external tax payment beats converting more with internal tax payment every time. Here's what ties all 5 mistakes into a single planning failure. Every one of them results from modeling the conversion in one dimension while ignoring 3 or 4 others. Raymond looked at his bracket. He didn't look at IRMAA. Stanley Whitmore's clients looked at the conversion amount but forgot about their 8606 basis. Donna could have ruined her conversion efficiency by starting Social Security too early. Edgar could have had a perfect strategy on paper and destroyed it by paying taxes from the wrong bucket. The IRS doesn't penalize you for converting. They incentivize you to convert badly, to convert too much, too fast in the wrong year, triggering cascading costs across multiple systems that don't appear on the same form, in the same letter, or even in the same tax year. The penalty for IRMAA shows up 2 years after the conversion. The penalty for losing your senior deduction shows up on the return you file the following April. The penalty for the tax torpedo shows up as a smaller refund, or a surprise bill that you might never connect back to the conversion that caused it. Your conversion ceiling, the actual maximum you should convert in any given year, is not the top of your tax bracket. It is the lowest of 4 separate limits: your tax bracket ceiling, your IRMAA tier threshold minus all other income, your senior deduction phase-out threshold minus all other income, and the point at which Social Security taxation shifts from 50% to 85%. Rapid-fire action list. Do these before your next conversion. 1. Pull your most recent Social Security statement and calculate your provisional income. Add half your annual Social Security benefit to your AGI plus any tax-exempt interest. Know which threshold you're near. 2. Check the IRMAA tier that applies 2 years from now. If you're converting in 2026, your 2028 Medicare premiums are at stake. The Tier 1 cliff for joint filers in 2026 is $218,000 MAGI. 3. Locate every Form 8606 you've filed since 1987. If you can't find them, request IRS transcripts using Form 4506-T. The IRS keeps these records. Your basis reduces your conversion tax. 4. Calculate your MAGI before converting and determine how much room remains below the $75,000 or $150,000 senior deduction phase-out threshold for 2025 through 2028. 5. Confirm you have liquid funds outside the IRA to pay the conversion tax. If not, reduce the conversion amount until external payment is possible. 6. Run the numbers at 3 different conversion amounts: the bracket ceiling, the IRMAA ceiling, and the senior deduction ceiling. Your actual conversion should be the lowest of the 3. Raymond Burke eventually ran the full calculation, but he ran it 1 year too late. His $95,000 conversion in 2025 already triggered the 2027 IRMAA surcharge. He couldn't undo it. Form SSA 44. The life-changing event form that allows IRMAA recalculation, doesn't cover Roth conversions. The SSA doesn't consider a voluntary conversion a qualifying life-changing event. Retirement qualifies, divorce qualifies, a Roth conversion does not. Raymond's 2026 conversion was different. He hired a fee-only financial planner who modeled all 4 ceilings simultaneously: bracket, IRMAA, Social Security taxation, and senior deduction phase-out. The planner identified Raymond's optimal conversion for 2026 at $82,000, not the $95,000 Raymond would have done on his own. That $82,000 kept him $4,200 below the IRMAA Tier 1 cliff, with a safety margin for unexpected dividend income. It preserved his full $12,000 senior deduction, and it added only $6,800 in newly taxable Social Security compared to the $23,000 his 2025 conversion had triggered. Same man, same tax bracket, same IRA balance. Different result, because the second time, he measured the true cost instead of just the obvious one. The IRS gives you no limit on how much you can convert in a single year. They want you to convert large. They want you to trigger every cliff, every phase-out, every surcharge that hides behind a 2-year delay or a connected threshold. They designed a system where the obvious move, fill the bracket, is almost never the optimal move. In the next video, I'm covering the exact year-by-year Roth conversion calendar for ages 60 through 75, including the specific income levels where each penalty activates and the precise dollar amount you should convert at each age based on your filing status. That video drops within the next 7 days. Your financial advisor shows you what a Roth conversion saves. The IRS counts on you never seeing what it actually costs.